Hello everybody, welcome to tonight's webinar on provisions, contingent liabilities, and contingent assets. We're going to talk about the topics related to IAS 37 and ASPE section 3290 related to contingencies. Before I start, I do want to make sure to check in if you can hear my sound, if it is okay. Please let me know in the chat. The copyright of the standards belongs to CPA Canada and other provincial CPA bodies from the CPA Canada Handbook. The interpretations below are my own personal opinion and all rights are reserved. The opinions below are my own and are not to be relied upon. The information provided below is for illustrative purposes only and is not advice or guidance. Learn Formula is not affiliated with or related to CPA bodies. Learn Formula's activities have not been approved or endorsed by those CPA bodies. Thank you for letting me know about the sound, so I'm just going to continue. Tonight I'm your session leader. My name's Henry and I've been teaching this for quite a while, and training mentees to help them get through the CPA. I am a professional marketer for the CPA and an independent contractor with them, and most of the time I do really like to share a lot of my experiences to help each mentee through. I do provide or generally structure a very or impose rather a process that has been really pretty much tested and vetted over the time to really help a lot of my mentees pass. And for the most part, hopefully they appreciate that they don't have to do the thinking part of it, because I've already imposed that on them on what to do. They just have to do the work, right? And it's a partnership when it comes to doing that. And this is really where I want to talk about making sure that you should reach out for your mentor. And most of the time, what makes Prep Formula different is, especially most of the time, is that you will be communicating with your mentor to help guide you through the process and improving, I'll call it, your edge to passing. And we get to share in on that joy when you do finally get to see your name posted on the website when you disclose it. But these are some of the most recent success stories, and a lot of you may be going through preparing for the CFI in May, and just because we're almost about 2.5 months away, just because you're 2.5 months away doesn't mean you can't start now, because there is quite a lot to go through when it comes to this journey or this plan that you have. And I'll tell you, the process that people say when it comes to cram, they don't actually say it, everybody learns to cram, and cramming for this exam is not the way to go. And this is really where the insights from your mentor is really going to help you. So before we start, I want to talk about a couple of things. Just make sure to, you get the webinar materials from before this class. And if there's concepts that I'm covering here that are a little bit too quick, maybe you haven't gone through learning the topic yet or not as aware, do watch the recording of it. I will try to just progress just for respect of all the other people who are attending. And then the other part I do want to talk about is make sure you email support@prepformula.com related to the study guide. And I want to go through the study guide because we are going to cover that topic today, and I want you to know how to go about finding it, okay? So this study guide, or companion guide I call it, is, we're going to go through the financial reporting competency, and I'm going to illustrate specifically in here as you read, obviously make sure you do your read through. If you've been watching my webinars, you've probably been hearing this spiel for a while, so I'll just kind of go through really quickly. In your analysis, when it comes to dealing with financial reporting, you're going to start trying to cover these areas here with relation to definition, recognition, measurement, subsequent measurement, presentation, and disclosure. And then afterwards, in the exam, you do have a tool, which is the handbook. And it's not something, if you don't know the section, so you need to be at a stage where when you're reading a case, you can pull out the assessment opportunity and recognize it's an assessment opportunity. Aside from pulling it out, it is an assessment opportunity. You need to be able to define and explain what that assessment opportunity or what the topic is, right? So tonight, our topic is going to be contingent liabilities and other provisions. And so I do go through and teach here specifically how to read the handbook, specifically for IFRS, what specific criterion you're going to try to pull. And then when it comes to ASPE, the same thing. That's what you're going to try to do, okay? And to go through the section, just as a very high-level bird's eye view for you to see, if I go through decommissioning provisions and contingencies, so these are the sections that we're also going to talk about and cover here, okay? And so in general, this is relatively straightforward. So here you'll see an opinion of what it is, and it's not really that difficult unless you're dealing with something called a decommissioning provision or asset, otherwise known as an asset retirement obligation, which can be complex. So we've kind of grouped these topics together because they're kind of the same with some nuances of differences, and we're going to cover some of those ideas. Now, the main thing I do want to talk about is what a provision means. A provision is an estimated liability. This is very, very important to understand. It is a liability, but it's not your traditional accounts payable. We have estimates, right? Like, so if you have an accrual for utilities or accrual for property taxes, you are making a provision. They're just using a different name. It's just an accrual and provision are generally the same names, but some people like to apply it in a different context. So just want to make sure we recognize that. So in this part, one of the largest flaws that people do is they actually don't describe and work through the criterion when it comes to the provision. So I've highlighted that for you just so that you can see. And one of the other things that is under represented is talking about the probable outflow of the economic benefits and a reliable estimate. Okay, so in order for you to record something on the financial statements, ultimately my advice is always to be able to produce the journal entry or the impact on the produce the impact on the financial statements, and the way that is represented is through journal entries. That's my opinion or suggestion for you. But before you can do that, right, financial reporting, the whole objective, why you're doing it, right, if you work through the issue, you work through the analysis, you work through your conclusion, you're kind of incomplete if you don't work through the journal entry. And this is the reason why. When we look at financial reporting, we're trying to understand whether or not we have permission to record this transaction or event on our financial statements. We need to determine where and how much. So if you can see, doing a journal entry or a series of them will best represent answering those three questions. And so this is why most people will struggle and say, you know, when I'm working through my financial reporting, I'm not getting the depth. Depth could be many reasons, and we're going to work through that tonight. And I'll show you the common things specifically to contingent liabilities that people miss. And so you will be able to see part of that. But ultimately, your financial reporting structure or approach is going to describe the issue. You're going to work through the necessary analyses to make it comprehensive as described over here. And then you're going to make sure technically it has those necessary components. And then you're going to provide your recommendation conclusion and ultimately the impact on the journal entry with a journal entry. Okay. So the next thing I want to talk about and show is the handbook. So with regards to the IFRS, what we are looking at is IAS 37. So relatively quickly, just going through IAS 37. Okay, and if you read the guide that I've provided to you, if you've already had it, you can see sort of the way this handbook section is covered. So be very careful here. This section covers provisions, so estimates of accruals, contingent liabilities. So the part that usually people will miss is not talking about what a contingency is. Okay, so contingent means you're now adding probability, right? And then the last part is contingent asset. So it's not just liabilities, it's also including the contingent asset part. So it's sort of, you see how the handbook IFRS has lumped these things together. Okay, now when we go through, the key part I want to talk about is, you see these definitions here, what a contingent liability is, okay, and then what a contingent asset is. So you see how there's criterion here that needs to be worked through. People skip this definition part. So, and you see how based on my guide, I tell you, or sorry, the prep formula guide that I have helped author, no bias intended, but the bolded, this is bolded, so this is what you are going to need and use, okay? Provision, so here's an example of what a provision is, which is an estimated accrual, and you'll see sort of how a present obligation is calculated. And again, so estimate, we're going to talk about what a best estimate is, and we're going to go through those criteria, but I'm just really high level showing you the necessary bold areas. One thing I want to make sure you understand is when you read the handbook, the areas that are unformatted, like these here, is sort of extra explanation in providing you the details. So, here it says the risks and uncertainties many events shall take into account with the best estimate. And this tells you how to interpret or apply that. And even then, it's still not that easy to read. So that's what these type of webinars here that you're all attending, hopefully this adds that additional value for you to see how the concept is applied from a professional practitioner, okay? The other things I do want to point out is just the headings of the handbook, to pay particular attention to the bold and capitalized. So you see how bold and capitalized definition. Generally, this is what your analysis needs to consider. Your recognition, and then your measurement. You see how it's bold and capitalized. So this is a small little tip, just I can share from an experience, how you approach and handle your analyses, okay? The second one now is to just talk about ASPE. Okay, so ASPE. So 3290, you'll see contingencies, okay? And very much similar. So they don't follow the same formatting, but they still do have the bolded. So you see how definition, measurement, uncertainty, accounting treatment when it comes to contingent losses and liabilities. So this contingencies covers losses and gains together. But you'll see the part that I highly mention in the guide is to suggest that you pull the areas that are italics. Okay, so you see here, this is what you're going to have to work through when it comes to the italics. Okay, so now we sort of have an idea of what we need to go through when it comes through to the handbook. Let's now just jump into the material. Okay. So really simply, I want to make contingent liabilities very simple and straightforward for you. So this is based on IFRS, and when it's based on IFRS, that's sort of the ground perspective I want to shift your focus when it comes to the topic. So there's many opinions which one, or guesswork of what your exam is going to be, but like in general, the mission and goal of CPA is to be a globally recognized designation. And what that will bring or entail is, in my opinion, would apply to applying IFRS. So I think they generally may favor IFRS. I'm not saying that's what's going to be on the May CFE if you're writing May CFE, but that's just something to recognize, okay? I know we operate in Canada. Most of the businesses are under ASPE, so you still have to have a good idea of both. But I honestly think if you know how to apply IFRS, applying ASPE is relatively not that difficult because the differences are very minor. Okay, so that's why you'll see from the guide it's listed by topics and it's not listed by separation of IFRS and separation by ASPE. It just kind of generally doesn't make sense. So let's kind of work through what a contingent liability is. There's really 3 layers or steps you need to go through. Okay, so you got your definition. Is it a liability? Is it contingent? Contingent meaning is it probable, right? And then is it material? If it was like $1 or $2, you can have contingent liabilities that are $1 or $2, but you're not going to record it on the financial statement. So, when people think of whether or not it's material, like that's almost an obvious thing that you don't have to state, right? Like if it's material, it will be on the financial statements. Okay, so the way I just want you to think about it is 2 paths, right? Is it probable? So what's the percentage chance that this could happen? And then can you measure it, right? Ultimately, this comes down, we're accountants. We need to figure out what's that number we're going to record on the financial statement. So if it's like, so then this is really where we've got to start paying attention, okay? So if it's probable, the action is to record it and disclose, which is very clear and obvious, okay? If we know for sure in the amount of the likelihood of what would happen or whether or not it's probable, we obviously would record it, right? And the notes are to provide additional supporting information to explain what's happening related to this contingency, so the user, when they read the notes, they can have a good idea how much of a risk this is for the company. Okay, so that's relatively straightforward and easy. If you know it and it's measurable, basically you're going to record and disclose it. Now, the next is the middle ground. And on the middle ground, if you don't know, okay, so the key word I want you to pay attention is probable. If it's if you don't know the likelihood of how much it's going to happen, all you are going to do is disclose it because it's material, right? Remember on the first level that we're talking about, it's got to be material before we actually consider it, right? If it's material and we don't know whether or not it's probable, but we know how much it is, we're generally going to disclose it, okay? And again, this gives the user, when we disclose it in the notes, an additional idea when they read those notes to make that interpretation. And so tonight's case is actually going to give you that idea too, and it's really important. And I'll kind of give you some insight from a analyst's point of view of how you would evaluate these financial statements, and then also afterwards from a practitioner's point of view, right? And then is it measurable? Very clearly, what you would work through that. Now, the main thing I want you to go through is if it's not measurable and it's not likely or probable, you're not going to do anything. You just ignore it. And sometimes that's the answer too, right? So be very, very careful, right? Like we're writing cases. Your answer could be wrong because of various case facts that you use that supports a differing opinion, which is completely okay. The key is, have you worked through the process? Okay, is your analysis thorough enough? And so when it comes to contingent liability, I would say there's three general steps, or well, in step one, there's really three things to talk about, three levels to talk about. Okay, now when we talk about ASPE, okay, this is generally a stated opinion. It's not like fully defined. The key part I want you to take away is in IFRS, their terminology is it probable? And ASPE, the change is it likely? So the difference between probable and likely is the interpretation or the feeling of that interpretation is it's greater than 50%. Okay, there's no hard rules similar to like lease, right? Like if it's greater than 90% of the MLP or 75% of the economic useful life, it's likely. So it's up to your case facts and how you stitch it together in your analysis discussion. Probable is in general less than likely. So I mean, like less than the 50%, but it's still like probable that it can happen. So it could be 10%, 20%, we don't know, right? The interpretation from IFRS is to take that if there's a possibility that this could happen, that's probable. Okay. Now, when it comes to measurement, most of the time they'll say if you don't know, you're going to disclose, and however you're going to approach it. Now, ASPE though has a specific range to take into consideration, and when I will tackle this later tonight, right? But when it comes to measurable, if you can't figure out the number to record, you just put your assumption down in your case. You just say based on the probable facts that we have, a acceptable number is this, and that's probably generally acceptable. Okay, you don't even have to state a number sometimes, but it's all case by case basis. So I can't give you a standard rule to follow, but I just want to say with ASPE though, if there's no range or no best estimate, you take the minimum. This one, ASPE has specific guidance for you to take the minimum. Okay. In IFRS, you could take the minimum, you could take the middle, you could take the high, whatever. Okay, you just have to. And when it comes to cases in our story here, in the exam, sorry, we're just trying to provide some information to support why we chose what we chose. Okay. Okay. So some very high level things here. These notes tonight are really summarized areas for the handbook for you to go through. And I'm not like pretty much the summary that I go through and what I think the value of these webinars is for these summaries, right? You want to make your learning easier. You want to have a reference, right? So you take the notes that you have from your study in terms of your technical knowledge. And once you take that technical knowledge, you want to be able to transform it in a usable reference way, which is what I've done here, so that you know how to apply it, right? Like you still need to go to the handbook and resource to refer to the material that you need, but trying to fully understand all of this stuff in that necessary detail is going to serve you less than you need, okay? So some things to pay attention to when it comes to provisions, though. So recognizing a provision is based on these criteria. It's probable there's going to be an outflow flow of resources. There's a reliable estimate, and but it's not future operating costs. Okay. So again, there's criterion that we're going to work through in the handbook, and there's specific criterion when it comes to provision. One thing I want you to pay attention to is owner's contract. Okay, this is a present obligation under the contract, which is recognized and measured as a provision. So the contract could be that you have to take over something, and you've got to consider it. Okay, so this is just something to pay attention to. They've actually tested this before, so I'm just highlighting this for your attention. Contingent liability. So a contingent liability is not recognized unless these criteria are met. Contingent asset. So I deliberately didn't go through a detailed discussion about contingent asset because I'm going to cover it here. But to be very honest, it's really straightforward and simple. Unless you have absolute certainty that you are going to collect it, and it's going to realize and happen, or pretty much if it's going to realize, then you're allowed to record it. Otherwise, you disclose it until it actually happens. Okay. So you never estimate a contingent asset to record on your balance sheet. You are only recording it when there is 99.9 or 100% certainty. Okay, now this is the measurement of the provision. The measurement is to use the best estimate, and you have to take into consideration risks and uncertainties, and this includes using factors related to present value, and then you have to include other future events that could happen. And this is more specifically with regards to asset retirement obligations. There's a separate webinar specifically to that, so I'm just really talking about the contingent areas here tonight. So I'm not going to go through ARO in detail, but ARO, the other side of, so there's an asset side and then there's a liability side, and when it comes to the liability side, it is a provision, it is an estimate. So that's just something for you to make sure you're understanding the section when it comes to IAS 37. It's not just contingent liabilities and asset, which is what ASPE's handbook is, but IFRS's handbook includes provisions. Okay, reimbursements, some discussion there. Again, these key things I want you to take away from these notes is these are case facts that you just have to pay attention to that could potentially trigger or you need to include in your analysis, and this comes with thoroughness of your technical study and gaining some experience practicing. Okay. And again, contingent loss, whether it's likely or estimable, and then contingent gain. It has to be a likely event. You're not to accrue it unless you for sure know. So now let's talk about the accounting issue analysis part. Identifying an obligation that is to be recognized, and discuss definition, measurement, presentation of the provision. Okay, so here's what you've got to work through in terms of recognition of a provision. And again, this comes a lot easier through examples, so we'll work through that tonight. Okay, some things to pay attention to is depending on the case situation, especially when it comes to what's called an onerous contract, you're going to have to include these other steps. Okay, so this depends on the case that happens. And so this is sort of what I would call optional management or board decision. So if it does not give rise to a constructive obligation at the end of the reporting period, unless the decision has been communicated before the end of the reporting period. And so obviously if a board or management makes decision, that's very clear. The second one is the entity has a contract that is onerous. So what that means is the present obligation under the contract is recognized and measured as a provision, impairment, loss, and other. And an onerous contract is a contract which you cannot avoid the cost or meeting the obligation. So there's something that's stipulating that you are committed to. So an ARO is sort of in the same category of onerous. Regulation has stipulated that you need to clean up the site, okay? But it doesn't follow under the onerous contract requirements because there's the main separating point is that regulation is involved enforcing you, or you're legally obligated. This one is different, right? So which one? The costs are unavoidable. If I acquire a company, or here's a good one. If I acquire a real estate asset, so real estate for whatever reason everybody loves and it gets hyped all the time. If I invest in a real estate building, let's say apartment building, there's going to be existing tenants in there, and those existing tenants, I can't kick them out because I would be running into some huge lawsuits, right? I can't kick them out to charge a higher rent, even though I can, even though market rent is higher. There's requirements that I need to assume these tenants and their contracts. So this is an example of when onerous becomes involved. Okay, so the contracts of these tenants are onerous to me because I'm assuming these tenants. Okay, otherwise the penalties is much larger than assuming the lost rent generally. The last is future operating losses. So provisions are not recognized for future operating losses. You can't assume, let's say you're a startup, you're going to be in a loss for the next 3 to 5 years. You can't accrue those losses. Okay, that doesn't count. You're not allowed to do that. Okay, and so one way you can argue is, well, if you assume you're going to lose or you're going to be at a loss, then let's say you're a software company and you're building software and you're assuming you're always losing money. So is your software that you're building actually impaired? So that's a question that needs to be asked. Okay, so I'm just trying to kind of open up your minds beyond just thinking, oh, I've got to apply these criteria and work through. Especially for topics like these, it's not as simple as a cookie cutter, paste it down and go. Sometimes you're given these unique twists, okay? Let's take into context of the CFE exam, okay? So CFE came out since 2015. They're not going to repeat the same contingent liability or whatever all the time. They will sometimes twist things up, right? And you have to be able to handle that. That's all they will twist it up to the point that as long as it's within the competency map, it's all fair game. So this is an example that this is A level. This falls under competency map, and you've got to learn to address that. Okay. Measurement of the provision. So the amount recognized is based on the amount best estimate. So you're estimating. I have some utilities that I'm going to accrue for. I'm going to base it on my past bill from last year with an average of maybe the year before. As long as I'm consistent with it, then and I've been close, then it makes sense, right? The thing that you have to recognize when you're measuring these provisions at year end, as you work through it, let's say once I get the January or the next month utility bill, I've got to correct what my estimate is. So maybe I have over accrued, so I have to correct that over accrual. When it comes to audit, right, like we try to verify whether or not the accrual amount makes sense, how they approached it, and we don't want them to over accrue. We also don't want them to under accrue. So just flipping back to financial reporting, we are now looking to determine how we're going to accrue, right? We have to figure out how much. Provision being measured involved in a large population item. So a lot of these I'm not going to go through in that detail because the scenario usually is around single obligations, but if you have multiple, then you have to do what's called a associated expected value. So if you have scenario 1 where there's a 10% chance, scenario 2 where there's a 40% chance, scenario 3 there's a 60% chance, whatever, right? Like you're providing expected values. That's why we're always looking at, if we go back to the initial chart that I shared with you, what's probable, okay? So those percentages. If it's a single obligation, obviously you have probable to work through there, and then a range of outcome. One thing I want to point out when it comes to measurement, and to come with this, right? In accounting, we want the most reliable number, but we recognize the most reliable number in terms of that information is not readily available, and that either needs to pass because of time, or we have to find ways of corroborating that source. So when you are making an estimate, it's very unlikely you will fall onto one number, but you can fall into a range. It's much easier to fall into a range. Let's say you want to, once you get your CPA, you want to leave your job and go to another company and get promoted. you have an idea what your salary range will be, but you don't know what the salary number would be until you actually get that job, right? So this is what's really important. When it comes to estimates, the next thing I want you to think about to cross your mind is ranges are involved. Okay, when you think of ranges, then the next thing to now attach is the likelihood or probability of those ranges. Okay, so that's really what I want you to think about it from a professional judgment standpoint. And then we have present value. This generally would apply for an ARO, right? But just kind of making sure you have an idea to include this as your thought when it comes to determining that measure. Okay, future events that may affect the requirement to settle the obligation, cost of cleaning up the site. So, if you were to do a 5-year projection of these costs, you have year 0, you have year 2, 3, 4, and then you have year when the asset or whatever goes to an end. You have some cleanup costs and other things that you have to take into consideration. That information can become more and more prevalent or available as you go through that passage of time, and that estimate also needs to be updated. Okay, so this is probably the most complex when it would go when it comes to the measurement. So the hard part is not the definition and the recognition. When it comes to these provisions, contingent liabilities will come with the measurement part. So that's where I want you to why I'm sort of focusing and having the detail here for you to recognize and see. Okay, so the emphasis is on the measurement. Okay, the difficulties in the measurement, not the emphasis, the difficulty. Okay, so in ASPE, contingent loss is really accrual of the contingent loss, the amount, and then can be reasonably estimated, and it's likely. Any counterclaims, the amount of the likelihood of recovery is taken into account, determining the amount that is recognized in the income statement. If the probability of success in the related action is less than likely, a potential recovery is not taken into account. So if you have a counterclaim, so if you sue somebody and you can actually countersue for a recovery, if it is less than likely, then you're not going to record that, obviously, right? But if it's likely, you can potentially offset it, okay? Information provides a range. Again, so when we think of estimates, we're dealing with range, probability, okay? And then, so here's what you would go through. The minimum range is recognized, and so here's the section for you to refer to. Again, I am much more supportive of you using and getting attuned with the handbook. One of the main things, because this session is a little bit lighter because of the topic, what I always I can add in some more things to tell you, that when it comes to your learning, focus on the concepts and learning the concepts and getting enough experience working on the concepts first, especially for financial reporting. Once you know how to apply the contingent liability, what you need to consider, whether or not it's likely, the amount, the range, the estimate. Once you know how to do that, you've got to learn how to use the handbook to do it. And the reason why I'm suggesting you to then, as a progression, go into the handbook to pull the criterion to find it yourself is because in an exam, you will handle scenarios that you've never seen before. Otherwise, they just repeat the same exam, right? And you have an advantage because there's a history of these exams for you to practice on. So learning how to pull that information and work within a reasonable time constraint once you've first learning how to pull that information from the handbook is one thing, and then afterwards learning how to do it under a time constraint. That's really the goal to get to before you know you are ready to write the exam. If you can't do that, you're kind of under preparing yourself. Okay. So the next part is identify and discuss disclosure of the contingent liability and assets. So again, pretty much kind of the same content when it comes to all of this here. Okay. Identify and discuss the accounting for restructuring. So this is one part, you'll see in the notes earlier, I kind of skipped over the restructuring notes because this is level C. You just have to be able to discuss what's involved in a reconstruction. Okay. So, if you are dealing with, I don't want your mind to go so crazy. If you deal with a business combination, and maybe with the business combination, there's some future contingency or a liability involved because of this business combination. They're not. I shouldn't say they would, right? But it's less likely to be wound together and get so complicated in that way. Okay, and this is similar to a restructuring. They're not going to give you a restructuring scenario where you're parting a part of a company, they restructured it, and then they have severance that you have to pay and all that stuff. So this is part of what I'm trying to talk about, the consequences of a restructuring, and this includes that type of detail. So that type of scenario is very less likely to happen because it's a level C, and they wouldn't go through this type of requirement. Again, this is my opinion in terms of my interpretation of it and the application of it, but just to be very aware that if there's a restructuring, the expectations is for you to potentially just talk about at a very high level to document and be aware of possible contingent liabilities, and maybe list out examples like severance pays, wrongful terminations, whatever you can come up with. Okay. So here are some of those notes, and I just suggest you to read them and recognize that they're there. But for the purposes of this webinar, I want to spend the time going through the depth with you guys. Okay. So here's the initial primer for you, which is Von Gut Inc. sells goods that are covered by a 1-year warranty, which customers are covered for the cost of repair of any production defects or for replacement of the goods. Revenue relating to sales of these goods is $6.8 million for the current reporting period. The past experience of Von Gut is that 90% of the goods will have no defects, 6% will have defects that will be repaired, and then 4% of these goods will need to be replaced. If repairable defects existed for all of these goods, repair costs are estimated to be $750,000. And if all of these goods need to be replaced, the cost of the replacement goods is estimated to be $3,060,000. So we are going to work through a specific case analysis, but what I want you to take a look at is from here. I'll give you guys about 2 to 3 minutes. Let's figure out what the measurement amount would be for this. Okay. And the part I want you to pay most attention to, is when it comes to measurement of the provision. Okay, so this is slide 14, about slide 14. And so go back to your slide 14, and then you're going to use one of these mechanisms to help you with that measurement. Okay, so I'm just going to go back to this scenario. And then let's see how you would go about applying that. And once you have it, please type it in the chat. Okay, so let's work through this. Now, I am gonna sift back to the previous notes for this. So the part that I'm pulling from is the provision is being measured, okay? Is being measured, involves large population of items. So this obligation means measured by weighting all possible outcomes by their associated probabilities. Okay? So, going back to the original question, what do we have? Von Gut Inc. So what do we have? 90% of the chance we'll have. Okay, so let's say revenue is 6.8. %, with of the goods will have no defects, so $0. Then we also have a 6% chance defects will be repaired, and that repair cost is $750. Then we have 4% times the replacement cost is 3. So what do we get? With here, since it's 0, the expected value is 0. Okay. Then here, the value is 45,000. And then the value here is 122,400. We add it all up. Provision is 167,400. Okay. So this is sort of the concept. So I just wanted to use this example to focus on the measurement. And let me just shrink the screen a little bit so you can see. So that you can see the expected probability. So if you add these percentages up, 90%, 6%, 4%, and then 90% will result in 0, so we're fine, $0. 6% will cost 70, so that's the potential risk exposure, which is 750,000. And that will be produce 45,000, and then the last is 4% will cost us 3.6 million, 3 million, and that'll be 122,400. So the total provision is going to be 167,400. Okay. So this is just isolating the measurement part, and when you watch this webinar again, you want to be able to practice each of those components from definition to recognition to measurement, and this is an example of one of those measurement scenarios, and there's also other ones that we will talk about, like a few of those that we'll talk about today, but just kind of wanted to show that example. Okay. So this next case, I do want to first make sure there's a caveat in front of it. It is a CFI case, and if you haven't done this CFI case, just kind of be careful that you are being exposed for it. And anyway, the short note is, you always want to be able to practice your cases fresh, but aware of it. Okay. So the next case, we're going to talk about a case. So let me just switch the screen. Just bear with me a second. Okay, there we go. So a couple of things. So this is the 2016 CFE, okay, day 2. And so we're going to walk through some complex examples, I would consider, for this scenario. And this is an actual past exam question. And so, you know, as we read through the case, I want you to pay attention specifically to how it's laid out. So you can see how background, it's 50, like on this page, and then assurance requirements, finance requirements, PM requirements, tax. You know, I don't want you to get so used to the formats all the time, but I want you to recognize that the information in a day 2 case is pretty difficult to read sometimes. So just be mindful of that. And so knowing these indices, obviously you're going to skip and not read your unnecessary role, okay? So let's say we are working through the assurance role, because that's first, okay? And so I'm just scrolling through, but one of the main things I just want to highlight is, you know, tonight's webinar, we're talking about contingent liabilities and contingent assets. So I've already kind of like pulled out the contingent liability, the assessment opportunities. But one thing I also want to make sure that you recognize is on this whole case, there's actually answers down here, okay? But I'm going to walk through these answers relatively shortly, but I'm also going to write my own response for your own interpretation to evaluate what a difference between the answers here and, you know, answers could vary, right? But everybody has, this one is the more correct one, obviously, but we just want to demonstrate how this works and sort of do it in a reasonable time frame. I'll be very candid with you. These answers that they present in the board reports where these cases are found, the timing of it is not possible, okay? So just be very mindful of that. Okay, so unfortunately I can't highlight this, but the whole paragraph I would highlight a couple of things. And I also want you to pay attention to, so I'm going to also shrink my screen at the same time. So let me just set up my question. Okay, so I would actually highlight the whole thing, and in my day 2, this is what I would write. So Madeline thinks there are some accounting issues that will need to be addressed, including, so this is very important, okay? Including the financial reporting impact of the recent losses in the commercial division, and whether these result in an impairment. She asks you to review Tankco's draft financial statements, discuss any accounting issues, and propose any necessary adjusting entries. She would like you to evaluate the impact of the adjusting entries. Let me just make this a little bit bigger. On Tankco's compliance with the debt to equity covenant and its borrowing base. So this is very important. First of all, most people see this, their first thought is, oh, it's FR, financial reporting issues. I'm just going to write issue analysis and recommendation and work through Henry's amazing webinar. That's only going to solve one component for you, which is the discuss any accounting issues, okay, and propose adjusting entries. So that's one part that it's going to address. But there's actually a lot of other things, okay? So this is where they tell you, including the financial reporting impact on the losses in the commercial division, okay? So this is actually an assessment opportunity or some way that you have to make sure you answer. And also, when you're picking up assessment opportunities, be very, very mindful. I'm just going to make this word very big, so you can see, of the word and. Very commonly, a lot of my mentees, just as I pick them up, or they go through some experiences with me, before I've trained them, they miss these words and. Okay, so if you're inexperienced, the first thing you're going to pick up is you're just going to do this part. Discuss the financial reporting issues and analysis. We don't know what those financial reporting are yet, but obviously no surprise today there is going to be it's going to be relating to contingencies. But we've got to make sure we address the impact on the commercial division, whether or not there is one, and then also we've got to talk about whether or not the results are impaired because of the impact of these adjusting entries. And lastly, she wants you to evaluate the impact of these adjusting entries on Tanco's compliance with the debt to equity covenant, and its borrowing base. And you'll be so surprised when people do these journal entries. They will do the debt to equity, and for whatever reason, they don't do the borrowing base. It's like any word after the and, they forget about. So actually, I'm going to bold this one too. So, when you're picking up your assessment opportunities, your first thing, and one of the things I really train my mentees to learn to do, is pick up the assessment opportunities, but make sure you're addressing the right assessment opportunity. Because there's the variability that people pick up the wrong assessment opportunities and therefore address the wrong one, but they could pick up the right one, but don't address enough or all of the assessment opportunities. So the best way for you, I highly recommend, is to actually type out the actual assessment opportunity, right? There's no difference in the interpretation here, okay? So you want to make these mistakes while you're in this study period or this preparation period, not the cramming period, okay? In your study and preparation period. So this is the first thing that I want to point out, okay? So now let's go back to the case. So, just kind of scrolling through, we're not working through finance. We're not working through tax. Now, remember, so from that assessment opportunity, you can watch Mike's webinar related to how he approaches a case. How I approach a case is similar. I have my nuances of differences too. I haven't really covered case writing on webinars yet, but if there's interest, I can definitely do it. But when it comes to this, right, if we go back to the assessment opportunity requirements, you can see, you can see, right? So Madeline wants to know some of the accounting issues, their impact on the recent losses on the commercial division. Okay, so this is, we'll see, right? And then here, discuss any accounting issue. So ask you to review the draft statement. So now I'm reviewing these financial statements and discuss any accounting issues and propose any adjusting entries. So one of the things I will particularly pay attention to is these notes. Okay. I'm just gonna, but for tonight's session, I'm just gonna change the color just so that I don't confuse you. Okay. And no surprise. Okay. One of those notes are down here. Going back to, so pink color is what I use to pick up requireds or assessment opportunities. You see how there is a assessment opportunity related to accounts payable and accruals. Okay, accruals or provisions. And then also now we go into equity, some things to, again, pay attention to. So I'm just sort of teaching you guys. So when you read this for the first time, a lot of people just kind of like, oh, these are financial statements, and glance through it. They don't actually like, they don't actually, go through and see how this information is presented. Okay, so actually let me clear out the highlight because I have double highlights now. So sorry guys, bear with me 1 second. Okay, so just so that you can see that, to focus your attention on the areas that have a note. Okay. Now let's read through the notes. So tonight we're working on contingent asset and contingent liability. So I'm going to ignore inventory and ignore property, plant, and equipment. just as a small secret, guys, these are financial reporting issues. Okay. Goodwill, financial reporting issue. No, okay, so now I see that connection of goodwill related to that assessment opportunity here. Okay, so I'm just going to highlight this the same color here, just so. Oh, actually, let me find a pleasant color to. I don't know if I can match this color, but I'll do this one because it's a little bit lighter. Okay, so these sort of match here. Okay. Okay. So bank borrowing, I'm gonna need to be aware of this. Okay. So there's the line of credit, long-term loan, covenant. I need to be careful of this. So the debt to equity ratio is that they require is 2-to-1, and then here's how total liabilities and total assets. So I will pay attention to going back up here. I need to know total liabilities versus total equity. Okay, so I'm just going to highlight it in this color just for now. Oops, wrong. Wrong formatting. Okay, and then you'll see, and then here there's a requirement. The line of credit is equal to, so here's another covenant here, okay, is equal to 80%. So you have a borrowing base, maximum 1 million. Okay. So one thing to pay attention to, if we go back to this assessment opportunity, you can see that borrowing base is not relevant here, so I'm just going to cross this out. Okay. Why is it not relevant? It's not included in the calculation, right? So I don't know if I can cross out in this online Word version. Sorry, guys. Okay, I'm just going to shrink it. Okay, so that's not relevant in the case that we need. Now, what's really important, where I think most people struggle when it comes to doing day twos, is actually organizing the information. I think they get super overwhelmed. They don't know how to categorize and work through the information. And this is, again, where it takes time and persistence with proper practice habits. So perfect practice makes perfect, to work through these things. Okay, so you need to be trained on these. Again, this is not a case writing session, so just kind of highlighting specifically, you've got to learn to organize and find a system or a process to organize that information for you. For me, I would make notes on the right-hand margin. I would mark that, okay, this is associated to AO number this, or this part here, whatever, how I would denote it, and then make sure I can make that connection. Okay. In my actual exam plan, what I would do is, on a day two only, I would have a paper plan, but I would also have a computer plan. Okay. So everybody has a different way of approaching things, and this is really where my way of doing things may not match the way that you do things, but hopefully you can see certain ways that I approach things, and hopefully I explain it well enough that you can adopt your own. Now, note 6, we see lawsuits. Automatically, when I see lawsuits, I already know there's a contingent liability. So new lawsuits, there's this, deductibles paid, lawsuits dropped. So the new lawsuit balance is 420,000. There's some information here that I will read and recognize later when we're going to solve it, but that's sort of how I would go about dissecting the case. Okay, so now we sort of know when it comes to this, I see there's lawsuits. Okay, the next thing, so there's one assessment opportunity to deal with the accounting issues with the lawsuit. Okay, so there's some discussions to protect against payout exposures and the problems here. The next one is cost of sales. Unionized plant worker, all of this stuff, and then approximately 800 tanks. Thankfully, none of these tanks were defective, resulted in oil spills. So here was the problem that they're describing to you and what's happening. Okay, so we've carved out the assessment opportunities that we are going to work on, and so now let's work on addressing it. Okay, based on what we're required to do. Okay, so I'm just gonna move this screen away so it's a little bit more friendly for us. Okay, and you know, I do have multiple screens, so I just shift things to different screens while I'm typing and working through it. But I think it's really important for you to find a way to organize. Obviously, you don't get multiple screens in the exam, so unfortunately, I don't know how you guys deal with one screen anymore. But you do get a paper copy, and you can use the case, and you can type and work through it. Anyway, okay, so let's talk about the lawsuits. Okay, so issue Tank Co. is currently experiencing a significant jump in the number of lawsuits against it from 4 to 19. Okay, so I'm just going to pull the case open just so that you guys can see what I'm talking about. Okay, so remember they used to have 4, now they got to like 19 and 21. Okay. The issue is whether a contingency should be recorded related to the lawsuits. Analysis. I'm going to pull from the handbook. So this is an ASPE case. I forgot to mention that, sorry. Oops. Okay, so there's measurement uncertainty. The contingency exists when there is a existing condition that involves uncertainty with respect to a possible gain or loss to the entity will be resolved in one of the future events, one or more future events to occur or fail to occur. Let me just scroll down on this a little bit. The lawsuit have been filed, so existing conditions exist. So they relate to existing conditions. These lawsuits, let me just scroll it up a little bit. These lawsuits are possible loss, payouts with minimum 20K deductible, plus any amount above the insurance coverage. There is uncertainty whether a payout will be required or what the exact amount of payout might be. The lawsuit will be resolved at a future date by settlement or when the lawsuit or when dropped. Okay, so a couple of things. The first thing I want to go through and discuss, and oh, actually I forgot to actually no, that's fine, is so contingent loss, we have specific criteria. The amount is likely and measurable. You'll see I haven't really gone through that yet. I only went through describing what that a contingency is and that it exists, okay? And so for the most part, I want you to make sure that you actually do that, because that's part of the definition. Now, there's no real italicized, okay, for this, but it's just something to say this, okay? Just something that you generally have to define, that the lawsuit represents a liability that is contingent, okay? So Eric, how do you know this is an ASPE case? Is written on ASPE? Yes, it is. I just forgot to mention and cover it. So it is an ASPE case, okay? Lawsuit meets, these lawsuits meets the definition of a contingency and should be treated as a contingent loss in the financial statements, okay? So what I want you to first recognize is what I've gone through here is defined contingency and liability, okay? Now, the next step is to apply measurement, okay? Now, when I'm going through measurement, I'm just going to follow a different approach. So here, I was using my own words with my experience to type that in. Sometimes that could be faster for me. Sometimes it would be slower. Sometimes I'd be incomplete. I have to figure out a process that I am most reliable on, and that comes from your practice and discovery, okay? So now I'm just going to use this approach where I'm going to copy and paste the guidance here. So the guidance says this: it is likely a future event. Oh, did I take the asset one by accident? Oh no, that's right. So here it is likely the event will happen. So I'm just going to apply the criterion. Appears the lawsuit. Let me just fix this part. Suits will result in a likely payout since very few have been dropped in the past and none on the seem to have been ruled in Tank Co.'s favor. Okay, so this is sort of one approach that I can suggest that you think. So let's look at these lawsuits. You can see on these lawsuits, in total there was 8, let's say, and then in 2014 there was 4. So the amount is accrued, what's been dropped. But in general, you see there's a generally growing balance, and then there's some that they've paid by deductibles, and then they've only dropped 1 compared to how many lawsuits and the deductible or the insurance has paid it out. So you can see their track record is not very high, and I'm using track record to explain it. Arguably, you could say, well, every case is an individual basis. You don't actually know. It could be a specific different reason. Fully fair and valid. But based on that information, I can't make that argument because there's no case facts to tell me that. So again, I want you to make sure your mind is open to be aware of those type of scenarios that could happen and not stick through such a very linear process of just, oh, you know, I remember a webinar that Henry did and he did it this way. I'm going to follow exactly the same way. You have to be flexible but you have to have enough experience and practice too. Okay, so you can be more flexible when you have a little bit more experience, but again, we're just trying to learn how to apply these processes here. Okay. So going back to the writing of it, Tank Co. has insurance specifically for this purpose of offsetting their total liability exposure by paying deductibles. You see how I'm using the case fact here? The actual likelihood of the lawsuits and potential payouts will need to be determined with the assistance of Tank Co.'s lawyers. But for now, my assumption would be to consider it likely, and therefore it is met. Okay? So do you see how we actually don't... So I sort of made that explanation. My arguments using the case facts is to support that, well, you know, they have insurance set up for this. They're growing in liability, growing in lawsuits, but they are... doesn't seem like most of them are being dropped. They're either being settled or fully exposed. So this is where their track record is not very good. And then at the same time, I actually don't know, right? I want to save my self in terms of providing another position. So I will also add in that, you know, alternatively, I'm trying to provide a balanced assessment. I'm not trying to be biased on one side. So this is also a small, subtle thing for you to pay attention and get used to doing too. It's not always, let's say, capital and expense. Some people just argue very clearly it's a capital, or some people argue very clearly it's expense. You've got to be able to see both sides, okay? And so I'm providing that opportunity, and which is where, you know, we actually need their assistance to give them that evaluation. But for now, my main assumption, based on what I have, is that it's likely and it's therefore met. Okay, so this is something very important, and I'm just going to add a little bit of a commentary in here for you guys, just to recognize here that I've made a balanced analysis of considering it as likely, but also not having enough information and what I need to do to draw my complete conclusion. Okay, so balanced or not having enough information, so that's where the gap is. Okay, no pun intended, the gap. Okay, the next one is the amount is reasonably estimated. So the amount, of the loss from the lawsuits are also estimable. And so at a minimum, we know based on those lawsuits, a 20K deductible needs to be paid. The unknown amount is the overall exposure. Typical settlements appear to be 255K to 410K. Okay, so I'm just trying to show you again. I'm pulling straight from the case, guys. 255 and 410. Okay, there's usually 20K deductible per claim, and then the insurance coverage is 5 million. So I'm going to start using that next, just to sort of put it all together. Okay, so typical settlements are ranging from 255 to 410. Do you see the range here and the estimate? Okay, and so from that standpoint, any exposure beyond 5 million. Any exposure within the 5 million insurance coverage could be clear. Currently, there are no lawsuits greater than 5 million. Okay, so based on this range of estimates for the loss with no amount in range, the ASPE says to use the lower, I'm just going to underline this for teaching purposes, lower range to accrue, which is 255K. Since the amount can be estimated and is likely, a loss provision should be accrued for the lawsuit in 2015 financial statements. As noted, there are 21 pending claims in Appendix 1 at 255K per claim, which equals 5.355 million. Tankco's coverage is 5 million. The question is whether these two amounts can be offset. Tankco has a history of, let me just scroll up, of lawsuits, and appears the insurance has always covered the claims. Therefore, it is reasonable that the insurance company is likely to cover these amounts should it happen. Okay, so we actually don't know whether or not all of it. There is an excess, but assuming. So conclusion. Assuming 255K is beyond the 20K deductible, 5.355 million less the 5 million coverage, there is exposure of 355K. If all claims were addressed in the coming year, therefore, this amount needs to be accrued. Okay, so this is really important. First, let's kind of talk about the answer before I go through the journal entry. So here, this is again my answer. So Tankco has experienced a significant jump. The issue is whether or not the contingencies should be recorded. Now I'm just going to pull open my answer the solutions answer. Actually, let's do that afterwards. And then there's the analysis. I've pulled the handbook criterion to talk about likely and unlikely, and then defined what a contingency is by going through the criterion of those things and applied case facts with it. And then based on the above, I've defined it as a contingency. Okay. Now, I've defined it as a contingency. I've got to work through the measurement. So once I've worked through the measurement, I've got to work through these two criteria. So first of all, aside from what I've just discussed and went through, the first common flaw that people work through is, if you've done core and PEP, most of the time you're doing those cases, what they're asking you to do is just this, okay? You can see they're missing a good portion of that here, Okay, and this is where sort of now the nuances between a CFE and a PEP exam starts showing up. Okay, obviously, right? Like as there's a little bit difference, and you can see from the competency map the requirements that they have. They start stepping up certain levels. Some that used to be at B at core level become A, and you've got to be careful of that, right? That's where the the competency map is important to understand. The next thing is, so now based on this, right? You've got to be much more thorough in your analysis. So this is standard and it's the same, which is okay. One thing I want you to now see is people start missing the part that I highlighted in gray here, and then the part that I've highlighted down here. So because they're so used to seeing core and elective exams. So again, this is my opinion, all right? Like, that's up to you. I'm just trying to give you guys best practices and what a thorough analysis is supposed to look like. You go through this and you're like, okay, well, I have this and I have this part, and you're wondering, why am I always getting RC? Well, this is the reason why you're getting RC, because you're performing and writing your cases at the PEP, the core and elective level. You're actually not writing at the CFE level because it's not comprehensive enough. And you can see just from that large paragraph that I've used, sorry, this is not really a super large paragraph, but it's a good size, it's half a page. I've written pretty much a 2-page response, okay? And I'm still not finished. So this is really important to understand that your case needs to have a good amount of content, not wasteful words, but a good amount of analysis. So the next step was to talk about, like they gave me a $5 million coverage. If I add up all the losses together, oh, do I actually have a good enough insurance coverage? And so I may not. And that's why I've looked at that, and then I see, okay, well, this is the next step I also have to look at in terms of that, okay? So this is one of the reasons why people get an RC in their analysis, because it's not comprehensive enough. They haven't shifted levels, and I want to make sure you see that, okay? So now, I made my conclusion. I've showed you the financial impacts. Here's the exposure, 255K, it needs to accrue, and then the additional 355K needs to accrue. So the next thing I'm going to do, please see Exhibit 1, AJE, I'll just say number 1 for the entry. Now this is not really number 1, but we'll kind of put that in place. This is also important to do. What commonly is done by many candidates is they just don't even refer to their exhibit that they've made these journal entries, and then as a marker you're looking through it. It's not like they're not going to mark it or anything, but it doesn't help your case. Okay, so I'm just trying to present to you some tips or useful tips to help you understand the details of that difference. Okay, so let's kind of work through what that looks like. Okay, so AJE3. G number 1, contingent loss, debit. Is 355. Credit, accrued liabilities, 355. Okay. Now, you may be wondering why I did 355 and there's 255K and 20K and all that stuff, but I'm looking at mainly if we look at the exposure. So let's kind of look at this. I'm looking mainly at the exposure, and if we look at the insurance policy, if they have 21 claims, there's 255. So if we add that all together, they're overexposed. They have 5.355 million in exposure. Most people, they would have maybe done this 255K, right? Maybe. The important thing to recognize is this was the part to recognize, which was the overall claim. So if I look at everything that they have available as lawsuits, they're exposed. Really, they're not going to be covered by their insurance. I'm already paying insurance. I'm already paying deductibles as expenses. But I need to start including anything that's outside of the policy that I have. And this is the big picture related to contingent liability that you have to be careful and very mindful of, okay? So so assuming 55K is beyond the 20K deductibles, I'm really needing to pay an extra 30. I'm underexposed, so I have to cover it. Okay, so that's what the accrual related to this is, and you can see the journal entry and then this. Now, I would do this in Excel, but for this class, because we're only just focusing on one, because why would I do this in that? I'll kind of explain a little bit later. But so now let's work through the next issue, okay, which was the warranty. And I'm going to work through this one a little bit quicker, but just bear with me 1 second, guys. So if I pull open the case and we go to now the note related to the contingent, cost of sales. Okay, so unionized plant workers 2015 went on strike for 3 weeks. Temporary hired and replaced union workers subsequently determined that there was lower quality units by those temporary workers. None of these workers resulted in oil spills but have been returned. Approximately 800 tanks were manufactured and shipped. 32 have been replaced at a cost of $400 per tank. Management thinks that another 50 might be defective and has committed to its distributors to replace any of these tanks. Beyond for those have been replaced, no amount has been included in the financial statement, so this is obviously important. So this hasn't been accounted for. And then in the past, it was rare for the company to experience returns from its distributors. So let's work through this issue. Okay, again, issue. I'm just going to write this down first. Analysis, recommendation. Okay, and then, again, I'm just typing straight from the case. Okay, guys? The company shipped 800 residential tanks that were manufactured during the strike. In 10 months, 32 tanks were found defective. The company replaced those tanks at no charge and is committed to its distributors to replace any tanks with defects for 1 year after purchase. The issue is whether an obligation for those tanks should be set up in the fiscal year or not. Analyze the issue. So now, one thing to recognize is a contingency. We've got to, again, define the contingency. Okay, so contingency exists when there are an existing condition that involves uncertainty. Kind of not wanting to type it, guys. Okay, so management has committed, let me just put this here, to replace any returned defective tanks, and the tanks have already been sold, so it is an existing condition. It is uncertain how many will be returned and need to be replaced, so uncertainty about the extent of the costs make this a contingent loss. The uncertainty will be resolved as tanks are returned after 1 year. So let's work through the criterion. Management has assessed the likely of the contingency and believes 50 tanks will be returned. Therefore, though there is no percent possibility on this, it appears quite likely after isolating it down to 50 tanks. Cost of replacing the tanks is known, of 400 each, and the number to replace is known, 50. Since the amount can be estimated and is considered likely, the loss should be accrued in the financial statements. Recommendation, at 400 per tank, the loss would be 20K. See Exhibit 1, AJE number 2. Okay, so I'm just going to highlight this in yellow. So as you guys can see, this is a very simple, straightforward response, but what you're going to be really surprised about is actually a lot of people missed it. Maybe because they're so standard and used to contingent losses and liabilities or provisions coming from the liability area when in the circumstances of a penalty or a lawsuit. But when it comes to some things like this, even from the product side, this does exist, right? Like recalls. So this is just something for you to further gain experience and recognize that, you know, if you're missing or not using case information that especially is at this scale, okay, like half a page, all right? So from looking at the CFE performance, we'll talk about that. People miss this whole thing, and it's like, you know, staring you in the face. You just don't know. Maybe because of the pressure. But you've got to first recognize that you've got to create measures to do that. And this is, again, one of the things that I train my mentees to do is we want to first minimize our risk of not using all of the information that we have. And with enough practice, they'll learn how that information is used. And then afterwards, then they know the next is to recognize the topic and then to apply it. So again, this takes gradual steps that a mentor will hopefully walk you through these progressions. It's not cram and think of doing the same case over and over and hope the same AO will show up again. This is very false, okay? All right, so nothing to really talk about on this one because it's relatively straightforward. So you know, you guys can review the webinar notes and the solution with this afterwards. What I want to do is actually spend some of the time here to go through the answer that the CFE board has wrote. So this is the official correct answer. And, you know, we can sort of compare my answer to theirs if you'd like. But also, I also want you just to pay attention to how it's written. And we'll talk about some other areas of performance related to it. Okay, so I'm just gonna try to find. Oh, actually, I forgot to do the journal entry, guys. So just bear with me. So, AJE number 2, debit. Debit cost of sales, 400 times 50. Credit, I'll call it warranty liability. And then, so this is 20. Okay, so you know, for purposes of saving us time and stuff, like I'm not going to provide this Excel because it's just a very simple Excel. But what I wanted to, reason why I want to show you sort of a little bit of it is if we go back to the financial statements Okay, so if we go back to the financial statements, so if we go back to the appendix, okay, so you see there's sales and all this stuff. What do we have to pay attention to was the debt to equity ratio. And so we need to pay attention to the equity and the debt. So you need to actually copy the full financial statements related to this, right? And what you would do is you copy. So I would just kind of, what I'm going to do is I'm just going to screenshot this down for you to see. But oops, not this one. Just gonna oops, not that one. So what I want to do is I just want to like copy down the Excel for you to sort of see, right? There's a couple of approaches to do. So first, you obviously can do it as from a liability adjustment standpoint. So let's say, as stated, 7428, okay, and then increase in liability, this. But this is the key that I'm trying to show you. AJE number 2, AJE number 1, and then this equals revised liability. Okay, so this is sort of that example that I want to make sure that you see that by preparing the journal entries this way, especially on day 2, right? Like I would actually suggest you do that. You can make your likely. I'm not saying always, not saying it likely or probable, that you would have to make financial reporting adjustments so to use the final number for somewhere else. So you want to set up your quants in a way that it's easily usable. If you wrote this in Word, you're really going to be fumbling and spending a lot of time. So I'm just trying to make things a little bit efficient for you to recognize and see. So this is an example of how you would set up your quant when that comes together. But I also would make sure you label it properly. But again, this is not case writing, so I don't want to go into that detail. I'm going to copy and paste this later into the response so you guys just can get the Word document on this, okay? But again, going back to the case, I want you to pay attention to the solution of what they went through. Oops, I went a little bit overboard. Okay. Okay, so I really want you to see the difference, okay? In terms of the magnitude of what they cover versus what I expect you guys to do. Okay, so let me just switch the screen here, and let me half the screen on this one. Okay, that doesn't work that way. Let me try it this way. All right, so let's look at my answer compared to theirs relatively quickly, which the 800 tanks, pretty close, like word for word, pretty close. Okay, like because they're just taking case facts, and for my mentees, you're gonna see, you're gonna see, right, like. For my mentees, they actually know sort of the protocol to follow here, okay? But you'll see they don't actually structure it that way. When you look at my analysis versus theirs, like this is, much longer to read, okay? And sort of how they go through it. They didn't actually use the criterion exactly as the handbook. They kind of wrote it in a narrative format. And again, everybody has their style. But what I want you to recognize is from here, this is for the tanks, the 20K. You see their journal entries about the same. So for reaching competency, you have to attempt to discuss this provision. Okay, so attempts is a very vague word, but provides a reasonable. Reasonable means you've got to go through a thorough analysis. Okay, attempt could be as simple as describing the issue, a little bit of the analysis and recommendation, and you fall into RC. So we've got to be very careful. They leave these terminologies vague for a reason, but we just want to recognize that possibility exists. Okay. The next part to kind of see is, let's look at the next one, lawsuit. Okay. So lawsuit, they kind of wrote it exactly in a very, very different way. Okay. So it makes studying and learning from these a little bit difficult. That's why you've got to work with your mentor to kind of put these together and apply and put the judgment and experience together. But you see how they've gone through. They've generally kind of followed something similar to this, but not fully exactly. And this is something you can definitely go into the details and learn to solve. And I still highly recommend that you actually do. Don't just rely on my answers, because it's for education purposes. It's not fully verified for correctness. I actually do it on the spot, so that you guys can kind of see and get that experience. But here's sort of where that comes together. And again, we're looking at does not attain the competency, attempts to discuss the issue here. But that's sort of the thing. I just want to make sure that you have an idea to see how they evaluate. Now, one thing I want to pull up and show you guys to see. So just bear with me 1 second. Oops. So you're going to see on this screen, these are from the board reports. One of the things I first just want to hide is the rest of the issues. Okay, so I want you to see most people actually didn't do very well on lawsuit, right? Oh, let me just remove one of these screens. If you see here, most people didn't really do that well on the lawsuit because most of them fell into RC. Like, it's a relatively straightforward thing. What was the difference? They missed using the details, providing the insurance policy and recognizing that exposure is actually above the 5 million insurance policy. So they didn't recognize their policy wasn't enough to cover their potential lawsuits. So most people fell into RC. And then if you look at warranty costs, usually if people got it, most people did get it, but these are the ones that have gotten it, and that's where the 43% is. So on the actual exam, people were able to get it, so I do take my comment back. But the ones that generally are writing these cases that I mentor or work with, or like the ones who have that experience, they're missing this AO, and like it does happen because they're not careful with the amount of information that's there, or they're not sure. And so this was something common that I very much saw, let's say last year when I was marking this case for people to see, but from the actual stats of the people who performed on that year, it says otherwise. So every pool will have their difference in performance. And again, I track my stats with my mentees quite meticulously because I want to make sure they all pass, and I definitely watch that very, very detailed with how they perform on their overall exams. Or cases that they write with me. But anyway, so that's kind of pretty much it for tonight. I'm just going to open up here. Hopefully you guys found this webinar useful. It's not as simple as you think, it's not as straightforward as you think. It is relatively simple. The part that really trips people up is not taking enough of the case information and solving the elements. But most people just jump straight into doing the the likelihood and the measurable, and that's it. Okay, so now you can see from the stats that I showed you of the people that wrote that exam on that year in 2016 of September, most of the ones who wrote the lawsuit, they actually generally fell into RC thinking they only need to do that, and this is what we have to be careful to avoid. Okay. You bring up a good point. So lawsuits, pending lawsuits are included in AP and accrual. Shouldn't we make the AP adjustment there? If we kind of look at my document, you'll see here my journal entry is contingent loss, accrued liabilities. So it's kind of the same thing. I just didn't take the exact same name, which, you know, for all intents purposes, it still means the same thing. Would I get deducted for it? I don't know. Maybe or maybe not, but nothing serious, because I would still flow through the journal entry the proper way when I needed to calculate the debt to equity covenant, as an example. Okay. Okay, so that pretty much wraps it up for this evening. Hopefully you guys found this webinar useful. Again, just to point out, most people struggle with the measurement area and using enough case facts for the analysis. And with tonight's example on the case that I used, you know, try to maybe forget and work through the actual case before you do this, and just be aware of that before you actually solve it. And this is really where the gaps in working on this particular topic that people have, which is the measurement and having sufficient analysis when it comes to it. And this was a good example tonight how I hopefully was able to demonstrate that to you, and you guys can take that away for your studies. And that pretty much wraps it up for tonight. I want to make sure that you know, please do leave me, if you like what I've been doing, please do leave a positive review. It does help quite a bit for, you know, for future planning of webinars and knowing what we're working on and providing and whether or not it was useful for you. So I really appreciate some of the feedback that is there, and please do continue working through it. You know, 5 stars, right guys? 5 stars for a wonderful webinar. Anyway, thank you for tonight. I appreciate all of the time that you've taken to attend this live. Hopefully, again, it was useful for you, and best of luck, and see you guys at the next webinar from me.